All right, Tim. How'd you like that intro there, buddy?
I'll tell you, that was some professional segue that
Oh,
you
I know. Joel's getting good at this. Usually it's Money Mitch doing the segues because Money Mitch is
Joel.
off this week. He's on a
Right.
cruise. We hope he's
I,
enjoying himself. But Joel's getting good at these segues too.
Yeah,
my,
yeah. Well, who
my,
who do you think taught Mitch everything he
Ah,
knows? And you for that matter.
he taught me
All
too.
right.
I never learned though.
Mitch is Mitch is out copying me, sailing in the Caribbean.
Oh no,
I
no,
know.
no,
Well, we all
no.
want to copy
That's
Tim Quast.
Yeah.
Everybody deep inside just wants to live Tim Quast's life on the ski slopes, cruising. Oh, I'm over in the Mediterranean. I mean, Tim has figured out how to live life to its fullest here. Where I just sit in my trade cave and try to analyze whether I think this stock's weak or strong, or we got some supply and demand issues. I'm actually boring my life.
Okay, Tim. Tim, it's
yeah.
it's boring here. I mean, it's good time for you to take another month and a half vacation.
It
But
is. It
new
is.
options trade today.
Mhm.
What does that mean to traders?
Well, and people don't really think about this, that options expire and then they renew, and that it's enormous. And how I love to quote literature, theological sayings, that sort of thing. And so something comes to my mind. There's this great phrase from the book of Ecclesiastes in the Bible that says,
biblical on us.
it's not that I'm suggesting that some kind of biblical apocalypse is ahead of us. I don't think so at all at the moment. But the race is not to the swift, nor the battle to the strong, but time and chance happen to all. There's more to that, but the way I think about this from market structure edge is you want to reduce the risk of time and chance. And so when new options trade, there is an elevated time and chance risk because you don't know what's going to happen. I can tell you that from a trading perspective, how this impacts us is that there's implied supply and implied demand. And that is what options are. So when they reset, there will be parties who are expecting to sell volatility or buy volatility, and there may be some difference between supply and demand. And how would we know? Well, you could look at individual stocks and see where it is, but the risk is that there's a supply-demand imbalance. And here's my key takeaway. On days like today, how the market begins may not be how it ends. And it's because of this. So you can't just look at the futures and say, well, the Dow's down 42 points-ish, and everything's muted and everything's fine. The market could be way up, could be way down, and it will be due to some form of imbalance between the supply and the demand for options, and it's trillions of dollars. You have to think about that during earnings, too. We got 1,700 companies reporting results this week.
Oh my gosh, and we do here, Tim, and they're going to get some big ones. So we want to dive into the market structure on two of these companies, which are going to report tomorrow night. And they are Google and they are Microsoft. And these two stocks have been going kind of head to head here, which is so interesting. Usually they trade together, but they were trading opposite a bit because obviously Microsoft came out with the ChatGPT product and employing it and putting it into Bing. And people are like, whoa, if Microsoft picks up some a few percentage points of market share on Google with their Bing product, all of a sudden, Microsoft. So now we're seeing Microsoft and Google sometimes go in opposite directions, which I find so interesting here. I'm really curious what your system is looking at when you look at Google and you look at Microsoft as they both report tomorrow night.
Okay, well, let's have a look at this. By the way, as you were talking about ChatGPT, talking about artificial intelligence, and C3 AI is a great read, and I just happen to have it up here. So if you're looking at this, by the way, traders, the chart may show you the same thing, but this is not awesome. This is terrible demand, too much supply.
Demand's near 1.
Yeah, if you're getting,
it ticked up. It ticked up.
It ticked up a little bit, but 5 is what you need to have enough demand to sustain price. It's the bare minimum to me. Doesn't mean things can't rise off of 1. It happens on occasion, but it's a way to think about that. Okay, so let's look at Microsoft first. And I do think that this is really interesting, that I would never have thought that cracks would show in the great Google wall, but They have, haven't they? It shows that it doesn't matter how big you are. It's kind of back to the, the race is not to the swift nor to the battle to the strong, because all of them can fall. And I think that Microsoft has demonstrated leadership in AI, and there are fissures in search for Google, which is the core of Google's value. I mean, it's a very interesting
all of it,
thing.
pretty much.
Exactly. So heading into earnings for Microsoft, this is not bad. It doesn't portend a big surge. And here's all I'm looking at, folks. This is price. So the gray part of the graph, just closing price. That's all. This is the green part is an algorithm called market structure sentiment. It's demand. It's just computing the contributions of different purposes and time horizons to price. And those things fluctuate. And you can measure that mathematically. It's right at 5. It has not been below 5 in the entire span of this chart. That's very good. This is supply. So supply peaked here, so price weakened. If supply rises, price tends to weaken, all other things being equal. But look at it right now. The supply sides are way below trend and demand is steady. They're not separating. So I'm not looking at that and saying, well, there's going to be a big jump, but it tells you people are very confident in Microsoft. This looks good. Clearly, people are not short Microsoft. Doesn't mean the price can't fluctuate, but all other things being equal, this will produce in the 2 weeks preceding, not preceding, following results, higher prices. All other things being equal.
Just looking back here, and we'll test your system here, but it looks like it's going to pass this test pretty well here, because I'm looking at your top chart there, and you can explain, when you see, well, you can see when it was back at a 5, it looks like demand, when I started this chart. I'm trying to see, my eyes are getting bad here in the area, but it looks like at the beginning of March, we were around a 5, and we've just been upticking demand, been slowly upticking here. And you know what? Prices went up since then too. So, I mean, sometimes do you just look at, what's at a 5 and climbing? Or should you always should look at the supply side as well?
It depends on what your aim is. If you want to buy what I would call value or low volatility, you want things that are at 5 with declining supply. Coke and Pepsi reporting results this week. Both of them have those. Yes, and the data showed exactly what you would expect. Now realize, Coke is not growing. Coke is increasing prices. That's what drove PE or EPS for Coke. You have to realize that. So it's not selling more units, it's selling units at a higher price, but the supply-demand equation for Coke is very good. But this is the key. If demand rises over 5 and supply declines, we look for this condition, we look for it mathematically. We run a divergence calculation. So we can find that kind of stuff and say, well, that's where you want to be. And that's where the price gains came. When supply rose, then the price stopped rising. It's a very consistent theme. It's not perfect. There's no perfect solution, but it's so simple to be able to see supply and demand balances and imbalances that even I can understand it. That's the key. So now let's look at Google.
Yeah,
so how does Google compare? And I'll take the non-voting shares. I think the non-voting shares are a better reflection of shorter term behaviors, interestingly, and there will be differences between them. And who's using the non-voting stock? Well, indexes and ETFs in large part for their rebalances. Doesn't mean those firms aren't voting on outcomes, but if you're going to move in and out of things, you're going to use Goog over Google. So it's an interesting read on what will happen ahead of results. Well, it's not as good, is it? It's not. It's fine. There's the same condition exists that for Microsoft, that it spends a lot of time above 5, but it had a little break below. A little break below 5. And here you have rising supply and demand that is steady. Microsoft has falling supply and demand that's steady. If you're going to pick a horse at the moment, you pick Microsoft.
And maybe that makes some intuitive sense. I mean, again, you've got the nervous people out there. Even myself, I sold my Google after owning it for 15 years. So I was nervous about Microsoft. I hear this stuff. They pick up a few percentage points of market share. It's a big difference to both Google and Microsoft, because Google is basically a monopoly on search. So if all of a sudden people are like, I'm going to bing this with this ChatGPT and I'm going to get better answer, I'm like, that's a scary thought. And I've owned Google in my long-term portfolio I think I owned it for 12 years, and I've actually sold it here now. So
Wow,
I'm like,
well, you
I'm a
made a
little
bunch of
bit
money.
nervous about this. I took a huge, paying a big tax bill in that Google to do that. So I'm somewhat nervous about it.
Yeah. Well, it's at the moment it's justified, and the beautiful thing to me about market structure, and I repeat myself, not because I'm becoming mentally decrepit. That has already happened, but because repetition is the best form of emphasis. Market structure reflects all known inputs. You don't have to go know what all the hedge funds know, what the short-term traders know, what the stock pickers know, what the asset allocators know, because you can just look at it here and it will tell you. That's how I think about it. I realize I'm a market structure, nerd, but I like this view.
Let's take a look at Meta. That's also due to report this week. We
Wednesday.
talked about we also talked about the straddle on that being $20 would be a pretty big move here. But boy, just the way this thing's been trading, I have to say the market structure is gonna look pretty good on this one. Tim, what do you have to say?
I agree. While demand has weakened some, the best gains came when demand was well above 5 and supply was generally below trend. There is a cause and effect. So this little rise right around March options expirations and index rebalances, that's to meet needs, but it slowed the price for a couple of days. Here's the change. Soon as demand weakens and supply rises, that's a great time if you're short term to stop, because we got no further gains until supply dropped well below trend. Then you can get them again. But this is a classic setup that we have. Fact, this is named for one of our edge users. We call it the Hicks rule. If demand is either rising, has hit 10, or is very steady, and day over day supply falls, there is nearly a 100% chance of producing a gain of at least half of the volatility for that stock. So I'd look at this and say there's a very strong chance. Again, there's also a small percentage chance that it declines, because options will reset here. But if you look at this and say steady demand, falling supply, I would go look at it in a portfolio and say, well, what is its intraday volatility? That's how we read this. And I'll go into the Benzinga April 24 portfolio, I'll put it in here, and look at Meta and say, well, how much might I make? Well, not a whole lot, but you could probably make a somewhere between a 1% and 2% gain on earnings out of Meta. You say, well, I don't know if that's that interesting. Well, it beats the heck out of a decline, and you have a very high mathematical opportunity to produce that gain. And realize that's 1/255th of a year that you're making 1% or better, because there are 255 on average trading days in a given
I take
year.
1% gains all over the place. I mean,
Exactly.
and in my own personal trading, and obviously I do a lot of commissions, I do a lot of production. I'll enter a trade if I have a 0.1% edge on any given trade for my day trading. If I feel like I have a 0.1% edge, so 1/10%, I will enter the trade for that. I don't enter if it's under that, because I'm retail now. I do pay commissions. There's some considerations there. But I feel like if I have a 0.1% edge, I will enter a trade. So I'll enter trades for 1% edges too. What I would say is, though, it's hard to enter a trade 2 days ahead of earnings for a 1.9% edge, because it's predicting the options. We just looked at them a few minutes ago, and they're predicting almost a 10% move in this stock. So there's going to be a big move potentially in one direction or another. But you still like what? Well, let's just say scenario analysis here. How much does the market structure change if the stock beats or disappoints? Does it change rapidly? Or does this dictate kind of maybe even what happens after it reports? So let's say it reports and misses and dips. Is because the market structure is so strong that the dip is more likely to be bought?
The answer to there are two
multiple questions there.
Yeah, it's so there are two things to keep in mind. If a company reports before new options price, we have found this statistically to be true. The damage lasts longer. Why? Well, because the new information will be priced into the new set of options, and the options will be priced lower, and it has a drawdown effect on price. If you report after they've been priced, but you still have, if those options have effectively, if they're monthlies, 20 days to run, there's a lot of opportunity for people to come in and trade those options profitably, and stocks do better. So we always counsel public companies report after the new options are priced, because the damage of a miss will be diminished. That's one factor. Then we look at behavior. While all behaviors can set prices, it's one of the core principles of Reg NMS, no preference for exchanges. Fast traders cause short-term damage because they don't actually own anything. So if you have a day where the stock's down 10%, 15%, and the only behavior is fast trading where there's no change in ownership, well, it can bounce back very quickly. If it's stock pickers, 3 of these have, actually 1, 2, 3, 4, 5 of the 7 stocks here are being led by stock pickers, which is unusual. That tells us there's a lot of focus on what these companies are going to report. Active money prices the market only less than 1 out of 10 trades. Active stock pickers are less than 10% of daily trading volume. Fast traders are over 51% of trading volume. So if they come and go and hammer volume and move the price, but they don't actually change the real ownership of the stock, can recover very quickly. So
real quick, Tim, we're coming up against the clock here. But coming up to a big earnings week, more risk or more reward this week for traders?
Quick answer for you. This is the supply demand balance in the S&P 500. So demand actually looks pretty good. That's those little squares, that's options expirations. So that we just got through that. New options trade today. Does it go up or down? I don't know. I don't know the answer to that. Supply is way down. It has not reversed course. You look at that and say, well, it's not terrible. The trouble will be if we get to Wednesday or Thursday, we're out of this whole options expiration cycle. New options trade today. Counterparties true the books Tuesday. Wednesday is reality. If this is rising and that is falling, then we're in trouble. If not, we're fine. So that's a wishy-washy answer, Joel.
I love it.
The calm before the earnings storm, and it's also going to dictate the next move.
Yeah.
Okay. All right, Tim. So we're gonna get you're gonna miss a couple weeks, but we'll be following the market here real closely.
We will
Tim,
see you we'll see you next week, but then I'll be out for 3 weeks.
Okay.
Where are you going this time? Where are you going?
He's
Greece.
going all out.
Oh
Greece.
my gosh,
Go sail
man. I
and
just need a taste of Tim Quast's life just for like a week. This guy, man, he knows how to live it up. If you want to look at Tim Quast, live your life like Tim, because he enjoys life. Work hard, play hard. Go Tim Quast.
That's right.
All right,
that's good. Life's short.
Thanks,
guys.
Thank
Have
you
a great
very
week.
much.